Good afternoon and welcome to today's session of Business as Usual. I'm Audrey Russo, President and CEO of the Pittsburgh Technology Council, and I'm joined today by my co-host Jonathan Kirsting on all things media, as well as his role as Vice President of Visibility at the Tech Council. So a couple of things to just shout out appreciation for our supporters for this entire process. That's Huntington Bank. They, if you don't know about them by now, they are the largest SBA lender in southwestern Pennsylvania. They are very active in the tech community and have been long partners of ours. And also want to extend appreciation to AT&T for their sponsorship and support of today's session and many of the sessions that we've had. They're doing an incredible amount of work across our communities and for their customers in response to COVID-19. So just as a programming note, this week we have a great lineup of guests. I mean, obviously today's Thursday. It's so funny how the days blur, but tomorrow we are hosting Farnham Jahanian, President of Carnegie Mellon University. And next week we're already busy. We have the Global Chief Information Officer for Zoom, the President and CEO of Eaton Park Hospitality Group, Jeff Broadhurst, and Rich Lunak, President and CEO of Innovation Works, which is one of the most active investors in Pittsburgh in terms of tech. So a little bit, and then we also have Patrick McKenna from One America Works. He's going to talk about a new paradigm in attracting tech businesses to cities like Pittsburgh. So we have a busy week ahead. And so just a little bit about the tech and the format for today. So we've muted everyone, and that's just with the intent of making sure that no one has any kind of noise in the background. Also, just as a reminder, if anyone would like to take advantage of Flexible's mini camp, there's a link right on our chat that will allow you, if you have young children, to actually experience some safe and interactive fun and learning while we're doing this chat. As many of you know that it's probably really hard to get things done and to pay attention during this process. So we want this call to be interactive. Our guests are great. We've had a great relationship with the Federal Reserve and we're thrilled to have them here. You put your questions in the chat box and do not use the chat box for any kind of advertising. That's not what today is about. So with that, I would like to just bring on today's guests, Mekael Teshome, VP and Senior Regional Officer of the Federal Reserve Bank of Cleveland, and Mark Schweitzer, Senior Vice President and Advisor to the Research Director. I'm very thrilled to have both of these gentlemen with us today. So I'm going to jump in and obviously say good afternoon to both of you and welcome to Business as Usual and taking the time. Can we just take a few minutes to talk about the general work of the Federal Reserve Bank of Cleveland and what your respective roles are in terms of what you do? So Mark, do you want to start?
Sure. So the Federal Reserve Bank of Cleveland is the local regional office of the entire Federal Reserve System for this region. And we do two major functions in the research department. We do analysis on the region to better understand sort of how economic developments are happening here to inform the bank president. And then in addition, we collect information from sources and contacts throughout the region. And that's one of the key reasons why we have an office in Pittsburgh, is we want to know what's happening in the Pittsburgh area in Western Pennsylvania so that we can better report on conditions as they develop in the US economy. And of course, right now, you know, there are a lot of challenges and we're spending a lot of time, you know, looking both at, you know, potential solutions, but also reporting the challenges that our communities are facing.
Okay, great. So Mekael.
Yeah, and so my role is as a senior regional officer here is to monitor economic conditions in the district, as Mark pointed out. I also help brief President Mester before she goes to federal open market committees. And that's also focusing on regional developments. And I also manage the relationships that we have here in the region with stakeholders. These include our business advisory councils, our contacts for the Beige Book survey that we regularly conduct, and also our Pittsburgh branch board of directors.
Okay, awesome. So the Fed has been working for the past few weeks to roll out yet a new program of $600 billion loan program to support small and medium-sized businesses. So can you talk about the program, how it's going to operate, and where small businesses can actually access these monies?
Sure. So the Main Street Lending Program was originally announced in March. We don't have a date yet for when it officially kicks off, but it should be soon. And the program is really aimed at companies that are in the middle. So these are companies that don't have as easy of a time accessing capital markets as the larger companies, but they may be too big to qualify for small business lending. The firms that this program targets have fewer than 15,000 employees and less than annual revenues of $5 billion. So it's a fairly broad scope of companies that could fit into that bucket. So there's no minimum company size for that. And the program is also designed to encourage banks to lend more freely. And the Fed will do this by taking on a big portion of the risk of these loans off of the banks. There are a few loan types. I'll just highlight the facility for the new loans out there. These are 4-year loans. In the first year, principal and interest would be deferred. The minimum size for the loans is $500,000, and the maximum size is $25 million, depending on the amount of outstanding debt the firm has. So these are, not the smallest borrowers, not the largest borrowers, just those that are having a little harder time accessing credit. We're all familiar with the Payroll Protection Program. This is different from that in the sense that these are loans. The Main Street Lending Program are loans, they're not grants. And also the pot is not limited the way the PPP was. So it's not a fixed pot of money there. Mark, you want to talk more about the operation?
Yeah, sure. So the Federal Reserve System's pulling together sort of the operational setup in order to run this particular lending program. But I think importantly, we view this as part of a system of support. So there are, as Mekael noted, programs for capital markets, for companies that have a lot more funding. The PPP loan program is clearly designed as a forgivable loan, similar to a grant. It's designed to deal with smaller entities. And so we're not sort of in that space currently either. But the chairman in recent testimony in his question and answers noted, that we are continuing to look at different areas that, have credit needs that could or should be dealt with the Main Street program. So the one that was announced with the program that we're sort of continuing to develop is a look at nonprofits. So many nonprofits, wouldn't have an EBITDA rating that would say, we can lend to you based on your profitability. That is by structure not there. So there are a lot of nonprofits that face needs, and there is a current program. There's an effort to put together a program on Main Street for nonprofits as well. So that's just an example of, sort of the Federal Reserve definitely is treating this particular area as a strong, broad-based effort to reach out to areas of the credit economy that were in good shape prior to the crisis, should be able to be solvent after the crisis, and but have funding shortfalls that we can help address.
And so, will these opportunities be additive in terms of the EIDL money, the loans, as well as the PPP? Or is it too early for me to be asking those kind of technical questions?
So in each case, we don't want to create programs that are, competitors to PPP loans. But I think, increasingly businesses are looking out and saying, hey, that PPP loan program with its forgivable components for payroll, that's great, and really extremely generous, but it may not solve all of their needs.
Right.
And certainly for larger companies, it sort of was never designed to meet all of their needs.
Mhm.
So as a matter of fact, the Main Street program does not preclude an entity that got a PPP loan from joining and having a Main Street loan. But again, the programs are designed to work together rather than competing in any sense.
Sure, that's great. And so when do you think that we're going to get some information that people can start to understand what the offerings are under this program?
So the term sheets are available on the Board of Governors website currently. I know that's a little bit of a technical thing. There are frequently asked questions. Those are a little longer. I think, one of the things that is important to recognize is that a business doesn't come to the Federal Reserve and say, hey, I'd like to borrow, $2 million. The business goes to their bank. Their bank has or other lenders, if we can expand it out to other lenders. Their bank has experience working with us. Their bank also, will be the entity that sort of puts together the loan. And as Mekael noted, these involve continued bank participation in the risk. So the bank is still making you the loan. We set some of the terms. We buy a share of that participation, 85% in one case, 95% in the other. So that helps the bank considerably. They're not bearing a lot of the risk, and they are, not bearing it on their balance sheet either.
Right.
But they are still the entity that the business would actually go to.
Okay. So everyone should be looking for this via their banks at this point. Okay, so great. So let's shift. The Fed has taken multiple actions over the past few months to help stabilize the economy. Can either of you or both of you talk about that journey and discuss some of the prior steps that have already been taken?
Sure. So, when we think about what happens when you're entering a recession, the Federal Reserve starts with lowering interest rates. Those are, the federal funds rate, the discount rate. Those are not rates that you and I get to borrow at, but they influence the entire rate structure of the banking system. So while I don't get to borrow at that rate, it will lower an auto loan. It will lower other things. Now, importantly, I think the FOMC in making these decisions is saying, we're not trying to, stimulate an economy that can't be stimulated because, we're in this sort of shutdown, we're in a reduced activity phase. We know that, but we want to make sure that the economy is positioned for a smooth recovery. And so the FOMC did that. We've had a large number of programs that have been focused on particular challenges in both national and international large-scale funding markets. And that has included buying assets, treasuries on the open market. It included a number of different steps, but fundamentally, again, that is about saying we don't want the sort of underlying credit markets to be in a challenged position, because that's not helpful for it's not helpful for you either. Yes, you and I don't interact in those markets. I'm nowhere near those markets, but those markets determine interest rates that are relevant to markets that we do participate in. So the Federal Reserve has been very active in those dimensions, but I think that's probably a good enough summary for this group.
No, that's great. Mekael, you want to add anything to that?
Sure. Mark did a great job of outlining the actions that have been taken. I'll just add something that President Messer has said. She likens the aim of the Federal Reserve's actions in this situation as building a bridge from the economy we had in February to the economy we could have after the pandemic passes. So just as Mark said, we know that everything's shut down, but we're trying to set the stage for a sustainable recovery after that. So that's really the way to think about it.
Okay, that's great. And so but in terms of Pittsburgh, Mekael, what's some of the sentiment right now in terms of Pittsburgh? Are we just replicating every other city and our anomalies that are just, they're not outliers, they mimic other regions?
Right now, the story is very much similar to other regions. It really is, because it was essentially a hard stop everywhere or most places. So what we're hearing from business contacts, it sounds very similar to what we're hearing elsewhere in the economy. There's a concern that over time, I think the outlook has deteriorated a bit in terms of prospects for economic recovery. We did hear of firms delaying their investment plans because of that uncertainty and concerns about the ability to sustain payrolls further down the road. So Pittsburgh right now feels very similar to other parts of the country. We don't have a lot of quantitative data yet on hand for the region. The data are still trying to catch up with the economic reality. So it's hard to say in terms of magnitude what we'll see. My initial sense is that we may see a smaller magnitude of deterioration than other parts of the country because we have that diversified industrial base. But that said, you know, even some of the more stable sectors such as healthcare and education, they're facing difficult times too down the road. So it remains to be seen yet, but it's a very similar story to the nation.
Right. And we haven't really seen any overall unemployment rates. Those haven't been calculated or shared in any way. And I know they're lagging. We've seen actual
they're
numbers.
coming out on Friday. So
they're coming out on Friday?
It will be big.
Yeah, strap on our seatbelts for that one for sure.
Yeah, it'll be definitely probably at least 15%.
Wow.
Yeah, and I think
which is something we've never seen.
We've never seen that in Pittsburgh, I don't think. I guess maybe.
Not in our lifetimes. I mean, so it was the case in the Great Depression that, you know, we saw unemployment rates around 20%. In some metro areas, in some hard-hit areas in past recessions, we've had similar numbers, but we've never had numbers like this nationwide. And some areas of the U.S. economy are going to see, you know, will have unemployment rates that are going to be even higher.
So we like to think here in Pittsburgh that we have a great opportunity. I know you represent Cleveland, so we're not going to get into a Cleveland-Pittsburgh exchange.
Oh, just a little bit, maybe.
Just over here.
But we believe that because of the diversification and the work that's gone on over the last, you know, decade in terms of accelerating innovation and technology, that we have a added opportunity. And, you know, that's how we're going to continue to operate here. Are you feeling that sentiment, or is it too early for me to put you on the spot?
I'll take a stab at this. No, I think it's too early right now. The overriding concern is really getting through this big crater that's been created. So I think firms are really just thinking more about survival rather than long-term expansion. And the other thing to keep in mind is that the outlook is very cloudy. So firms are a little hesitant to think about plans for expansion because we don't really know at what point things will get back to normal.
Well, there's two statements on the chat. One is reminding me, and I appreciate this, from Diane Bowser. Cleveland and Pittsburgh are intertwined. Our mutual growth, survival, and prosperity is linked together. So I appreciate you saying that, Diane. And unemployment rate in the region in 1983 approached 18% overall. And also to remind us that along with Erie, Buffalo, and Wheeling, they're really part of our, what are they called? CSA areas. Is that correct?
Or Rust Belt, right?
Yeah, it's a little bigger than the combined metro areas, but yes. I mean, it's definitely part of our region and part of our experience, so.
Right, okay. So you've been keeping a survey, the Federal Reserve Bank of Cleveland's been keeping a survey of sentiment relevant to COVID. How about both of you sharing with us what you found and what are some broad trends and what are you seeing?
Sure. So we created a daily survey.
Ah.
It's conducted daily, which is a contribution to the information that we have out there. And this is, the survey is focused on forward-looking consumer beliefs about the impact of the virus. And so that's a unique contribution too, in that it's focused on the COVID pandemic. We asked a variety of questions such as what consumers expect the impact to overall activity will be 12 months down the road, expectations for inflation, have households delayed purchases of large items, have they increased their cash savings, and those types of questions. And then more importantly, what's unique to the survey is that we ask about the expectations for the duration of the pandemic. And that's kind of the key here. So as far as the takeaways, what we've seen is that over time, consumer expectations about the impact of the virus on the economy has gotten worse. So consumers now expect the hit to GDP growth to be more severe than they initially expected. We also saw an increase in the share of respondents that are delaying large-scale purchases or large items. So early in March, 40% said that they were refraining from large purchases. More recently, it's up to 80%. That's a big jump there. Mm-hmm. And then in terms of the duration of the pandemic, in March, a little more than half said they expected it to last for 6 months or less. Mm-hmm. Now it's just 1/3 that expect it to last 6 months or less.
Wow.
And 2/3 of the respondents think it'll last a year or longer. So the expectations have really deteriorated. So this has significant implications on the outlook. And what it highlights for me is that really any kind of recovery is contingent on how well we contain the virus. Right. And so the public health aspect of it is really the foundation on which economic policies can be successful. And then the other thing is it tells me that whatever recovery we have could be slow, because 2/3 of economic activity is consumer spending. And if households don't feel comfortable going out and spending, that it's harder to get meaningful rates of growth.
Right. Sentiment matters. I mean, that's, perception matters. And I know that, we are seeing the fallout in terms of our service industries and our lodging. And I'm sure that other cities are seeing the same thing as well. So appreciate that, and appreciate that you're doing that kind of daily inquiry. Jonathan, there's a statement and a question.
There is from Griffin Schultz. This guy is on our calls every single day. I love Griffin. He's always got great questions. So thanks, Griffin, for the good questions. So he's asking this. State and municipal budgets are taking big hits resulting from the pandemic. The Fed took an unprecedented step of saying it will buy municipal bonds, but that program is only for very big cities. Can the Fed do any more here to help with state municipal budgets? Or its hands tied at this point?
Yeah, I'll take that question. So in the initial term sheet, it was very structured towards very large states and actually very large municipal areas plus states. And the idea being that states would subsequently lend out to other municipalities that were smaller within their area. Now, it turns out that, that's a problem in Ohio, for example, because the state constitution doesn't allow the state to do that function. So we get feedback like that, and then we adapt the program to make it broader based. So in that particular case, we've already pulled down sort of what the minimum is for a municipality to enter the program. That said, we do need, we can't do everything. And we need to be kind of aware of not overwhelming our systems in order to reach out to who we can help and how we can help. So yeah, I think the program's already changed some. It is important that municipalities and cities get some support, and we've definitely entered into that process.
So what do you both think, as we wrap down our time with you, which we deeply appreciate, what do you both think that we should be doing or could be doing for those of us that are building tech companies and are building for tomorrow? Because, you know, we've had some good stories even in the last week here in Pittsburgh. We had a company called Voci Technology, had a great exit. And then another company called Niche, they actually had a tremendous investment on a Series C in the middle of all of this. So, you know, we hang on, you know, our hats to tomorrow. But what do you think that we should be doing and we should be thinking about?
You know, I think all businesses, you know, are sort of looking at today's environment and trying to organize and plan both for sort of how do I manage my continued functioning today. Clearly, I want that. I want everybody to be kind of careful about sort of how do I think about where we are today. But especially with a future-focused group like the Pittsburgh Technology Council, we also want to be looking forward and saying, yes, we should see a recovery out here. We should be looking at opportunities that are developing. We should be continuing to explore new options, because that's fundamentally where a lot of the growth in the economy comes from. Mm-hmm. So, you know, I think, you know, from you know, what we expect of you is what you normally are out trying to do. And I think, you know, I wish the very best to all businesses that, you know, participate in the Tech Council.
Okay, I think, Jonathan, are there any more questions? I want to be sensitive to everyone's time. I know there's...
Yeah, I think we've got one quick one we can kind of wind up on here. And there's actually a nice sentiment about the idea of making a Cleveburg type of a zone where we can really put us all together to have a more powerful stance. But there's a question from Beverly Weiss, Maine here, talking about have any banks in the tri-state region failed recently due to the COVID-19 pandemic?
There haven't been any banks that have failed due to the COVID-19 pandemic in the region, and as far as I know, not the nation as a whole. You know, there were a couple small banks that failed late last year in Kentucky and Ohio. But, you know, I think this is a difficult time for banks. We are definitely working to make sure that we have the correct underpinnings to support any solvent banks. And right now, you know, they continue to be solvent. But yeah, this is going to be a challenging time period.
Well, you know, on a positive note, I want to thank both of you for the work that you're continuing to do. It matters to all of us. And I really appreciate the time that you've taken with us. And if there are any other questions that people have, we can help facilitate the answers to that. So thanks to both of you for the work that you're doing and for joining us. And everyone stay tuned. Tomorrow is Friday, hard to believe. And we have Farnham Jahanian, who is the president of Carnegie Mellon University. Thank you both for being with us. You're really doing some great work.
Good stuff, guys.
Thank you so much for having us. It's a pleasure.
Yep, thank you.